Today, we will talk about foreign currency, FX, swap, definition, how it works, and types. A foreign currency swap is an agreement between two foreign parties to swap interest payments on a loan made in one currency for interest payments on a loan made in another currency. In some cases, the principal amounts of the loans are also swapped, but not always. The purpose of a currency swap is often to obtain loans in foreign currency at more favorable interest rates than those available through local markets. During the 2008 financial crisis, several developing countries used currency swaps to address liquidity problems. There are two main types of swaps: fixed for fixed rate swaps and fixed for floating rate swaps. In a foreign currency swap, each party pays interest on the other's loan principal amounts throughout the agreement. When the swap ends, the principal amounts are typically exchanged once more at the agreed-upon rate or the spot rate. Currency swaps can be tied to the London Interbank Offered Rate and will soon be tied to the Secured Overnight Financing Rate, SOFR. The two main types of currency swaps are fixed for fixed rate swaps and fixed for floating rate swaps. Sometimes, the principal amount of the underlying loan is not exchanged in a swap. Foreign currency swaps can help companies borrow at a favorable rate and reduce exposure to exchange rate risks. Currency swaps can be used to secure cheaper debt. For example, companies can use swaps to borrow currencies at a favorable rate, based on exchange rates and interest rates. If the swap involves the exchange of principal, that principal will be exchanged again at the maturity of the agreement. Institutions use currency swaps to reduce exposure to fluctuations in exchange rates. Companies can take positions in each other's currencies via a currency swap for hedging purposes. The profit on a swap can offset losses from fluctuating exchange rates affecting their business activity. Foreign currency swaps serve two main purposes. They help companies access loans in foreign currencies at a lower cost than through local banks, and they provide a way to hedge against risks due to exchange rate fluctuations. Foreign currency swaps can involve the exchange of fixed or floating rate interest payments on currencies, or a combination of the two. They can also help companies borrow at less expensive rates than from local institutions and hedge against exchange rate risks. The first foreign currency swap is believed to have occurred in 1981 between the World Bank and IBM Corporation, marking the beginning of this financial practice. Here are 5 key takeaways. 1. A foreign currency swap is an agreement between two parties to swap interest rate payments on their respective loans in their different currencies. 2. The agreement can also involve swapping principal amounts of loans. 3. The two main types of swaps are fixed for fixed rate swaps and fixed for floating rate swaps. 4. Foreign currency swaps can help companies borrow at a rate that's less expensive than that available from local financial institutions. 5. They can also be used to hedge, or protect, the value of an existing investment against the risk of exchange rate fluctuations. Hope this would help. Thanks for watching.